On US inventories in businesses increased slightly in February amid strong sales growth. Revenue revised down to sales with correction of cost of sales in accounting. Empirically, US households stocked up on goods ahead of tariffs. The premise is that manufacturers replenished inventories at total cost pre tariffs, implying tariffs are incorporated into costs, implying price of goods increased at least by tariffs, and the bandwidth for the effects of inventory building. In business logic, that means inventories replenished before tariffs do not carry the cost of tariffs and hit the market at pre tariff prices. Stock price analysis, since current day production prices are affected by market prices for products in this aggressively increased by tariffs. A comparative analysis indicates that the buyer will accept the threshold of increment in pricing and margin of inventory replenishment, cost of reduction. So the size of aforementioned inventories is likely to hit the market discounted versus post tariffs. As a buyer, we would be interested to buy discounted at a margin that varies between global proliferated tariffs, ranging from 3% to 145% as a variable weight component of global sectors in dollars. At the same time, when inventories were replenished at a discounted rate, sales overall increased at the same time, leading us to the conclusion that manufacturers were producing for inventories and an increase in sales. JP Morgan states as sales came in high and additional production occurred allocated to inventories. Overall aggregate national output related to revenue as a component is set to come in high, as it did for the February reading. A reoccurring theme, as you know, is to look at the forward-looking movement on the macro trend. Within this specific case, a view on the 3-month outlook, especially inventories and forward-looking economic activity. Pre-tariffs cost of production is set to come in with material weight lower than post-tariffs, since tariffs are incurred at a cost if market prices dictate a marginal upswing in price paid by buyers. That indicates a pocket of excess margin in this comparative analysis. Monetary policy response assessment by the ECB in tariff trade turmoil. Expected, and it is expected, is a seventh rate cut of the benchmark rate in about 1 year. As 7 seems an excessively high number, we will look to policy response over the backward term of a few years that lead to a high degree of bandwidth within which benchmark yield can move within. Aforementioned postulation is incorporated with the generalized outlook. So looking back at the previous few years, we attain information where the economic playing field allowed for a bandwidth which allowed for 7 rate cuts in about 1 year. As you know, excessively unusual and indicative, likely a crisis event, and an extreme high degree of volatility.